Now, obviously, there is more to trading than just buying and selling a stock from time to time. There are countless things to factor in into each and every one of your trades. So basically, everything we have talked about so far is pretty much general market knowledge, and I just wanted to get everyone up to speed with the basics. But now it's time to get down to business and learn the trading tactics that I personally use to make money in the stock market. So from here on out, pay very close attention to everything I say, because you're about to learn the ins and outs of the Foos 4 strategy. First up, we're talking about the 13 EMA, one of the most important things that I'm going to be talking about in this entire DVD. It's basically, I like to consider it the backbone of short-term trends. So there are a vast amount of trend indicators out there that you can use to determine whether a trend is bullish or bearish. You can draw your own trend lines, use numerous types of technical indicators, or moving averages. The best way, in my opinion, is to simplify things and use just one or a couple few indicators to indicate trends that you find suitable to your strategy. As a short-term trader, I really only care about the short-term trend. What is the stock doing now, and what has it done over the recent past? How the stock has trended 3 to 5 years ago will not be nearly significant as the near-term trend when trying to forecast what will happen next on a short-term scale. After years of trading, I've found that using the 13 EMA is an excellent tool to have in your arsenal to indicate what type of trend the stock is currently in and whether or not you should be in or out based on being long or short and where the price is in relativity to the 13 EMA. It's really quite simple. If price is above the 13 EMA, then the short-term trend could be considered bullish. If price is below the 13 EMA, then the short-term trend could be considered bearish. If and when price crosses the 13 EMA from one side to the other, this can be taken as a possible trend reversal indicator. So for example, if price was above the 13 EMA and is considered bullish, once price crosses below the 13 EMA, the short-term trend has now changed from being bullish to bearish. The 13 EMA is simply the 13-day exponential moving average. A moving average is basically the average closing prices of a certain amount of days that you choose, plus a bunch of other stupid complicated calculations that we won't need to know because all of our charting software will automatically calculate for us anyways. In addition, it would just be a waste of time for me to explain it, just like every math class that we took in high school and college was a huge waste of time. Now, of course, no indicator is perfect, and the 13 EMA is far from perfect. If there was such thing as a perfect trend indicator or strategy in the market, then it would be very easy to make money in stocks. Yet making money consistently is a very difficult thing to do. So just because a stock crosses the 13 EMA from one side to the other, it does not always mean a trend reversal. It just implies the possibility of a trend reversal, and you have to make the decision of whether or not to act on that implication. But overall, the 13 EMA is without a doubt a very solid short-term trend indicator that I've been using for years to identify short-term trends, and I use it every day as a trader to help me make decisions. Small cap stocks in the move can often follow the 13 EMA very closely. This does not mean that the 13 EMA sits side by side price action, but the stock may rally and fall back down to where the 13 EMA support is and then bounce off the 13 EMA and continue the rally. It may do this several times before it finally breaks down the 13 EMA trend support and potentially reverse the trend or slow down the current rally and remain choppy for some time. So there are several ways to implement the 13 EMA into your trading strategy. First off, you can't just look at any stock chart and start using the 13 EMA. You must first identify that the stock is currently trending along the 13 EMA already or just broke out of a chart pattern that indicates the possibility of a new trend in play. Otherwise, the 13 EMA could be rendered useless. Many stocks are very choppy and are crossing above and below the 13 EMA very frequently. So these are the types of stocks we want to avoid. I typically only use the 13 EMA following a breakout from one of the Foos 4 chart patterns that I'll be going over next. This is because when a stock breaks out from a bullish chart pattern, this is an indication that a new short-term trend may be in play. The 13 EMA is a great trend indicator to use following a breakout to identify the new current short-term trend, if in fact there is one. Following a breakout, if price cannot hold above the 13 EMA, then in the near term this is an indication that no new trend is in play and it's actually a false breakout. So now we're going to talk a little bit more about how to implement the 13 EMA into your strategy. So after a stock breaks out from a bullish stock chart pattern, the 13 EMA comes into play and is now an area where traders will look to buy the stock on a dip if and when price action does so. Typically following a breakout, the first dip to the 13 EMA is the most reliable place to buy more shares of a stock to add to your current position or start a brand new position if you didn't buy into the breakout already. The first retest of the 13 EMA is a very strong support area, and it's a very common place for price to bounce strongly off the support level on its first retest. A strong bounce off the first test of the 13 EMA is usually a good sign that there is enough buying power in the stock to start trending along the 13 EMA, or at least get a nice spike to new highs following this event. Yet the more times price action tests the 13 EMA, and the higher price gets above the initial breakout, the higher the probability of price action breaking down the 13 EMA and potentially reversing or slowing down the trend. I will usually only consider buying into a stock following the breakout on the first pullback to the 13 EMA. If price action bounces off the 13 EMA after the breakout, then any retest following, then I'm looking for this to act as a support and hope that price does bounce from here and I'm able to continue riding the trend. Or I will look to sell my stock if price action starts to break down below the 13 EMA, as I'm not looking for a long-term trend here. I want to be in and out of the stock within a few days to a month or so, as I'm only trying to grab a piece of the short-term trend. The second test of the 13 EMA of a strong short-term move can often be the end of a short-term rally. So this is the place where it may be a good idea to lock in your profit if price starts to slide below the 13 EMA. Yet it is also very common for the stock to bounce off the 13 EMA several times and continue much higher before finally breaking down. Just take note that the more times price bounces off the 13 EMA and the higher the stock gets above the initial breakout point, the higher the probability of the 13 EMA breaking down and the trend possibly reversing. But as long as price stays above the 13 EMA, then the trend is considered bullish, and there's no telling how high the stock will go. So again, it's important to be aware that no indicator is perfect. Support areas such as the 13 EMA are very fragile. When a stock reaches the 13 EMA, or any support area for that matter, trading may become somewhat frantic, as this spot is either where a vast amount of buyers will come in and price action will rise off the support level, or too much fear sets in and the stock breaks down support, which can cause holders of the stock to sell and drive price action down. So in many cases of using stop areas, you will get stopped out by just a few pennies, or you will panic and sell, and then the stock will rally right after you sold it, because it's common that you won't have the perfect stop loss point set because the market is not perfect. Sometimes it's just a matter of instinct when deciding whether or not to sell on a support breakdown, because the 13 EMA or any support is not a perfect indicator. The 13 EMA is an exact number at all times. So when a stock dips near the 13 EMA during intraday price action, it may drop slightly below it and then maybe just trade in a tight range around the 13 EMA before it rallies off the trend support. So the 13 EMA is a general support area range where new buyers may come in. If no new buyers start to come in at or slightly below the 13 EMA, then it is very possible that sellers may be taken over and the trend could be reversed. Using the 13 EMA as a trailing stop places you in a position where you will always be riding the short-term momentum and simplifies things so that you're not confused and worried about where should I sell this stock if and when it starts falling. Placing stops is a very difficult thing to do, but using the 13 EMA helps simplify the guesswork out of the trade. If and when a stock starts moving below the 13 EMA following a breakout, then it is common that the trend may be reversed and you should lock in your profits if you have any. Trading off the 13 EMA again is never going to be a perfect strategy, but it will definitely help you make some of the most important decisions of your trades. And that decision is, when do I sell this stock? Okay, so now we're just going to go over some actual examples of looking at the 13 EMA on a stock chart. So basically this blue line here is a 13 EMA. You can pretty much any charting software or website that you're using, you'll be able to add the 13 EMA to your chart. So looking here, you can see that the 13 EMA was actually already trending along this stock here. You can see it rode it all the way up until it finally broke down here, where actually this stock just kind of started chopping around here. As I said, once it breaks down, it's either an indication of a slowdown in the trend or a trend reversal. So after it broke down the 13 EMA trend here, it was just kind of choppy and didn't really do much going up and down. But the trend was actually reversed and actually dropped all the way back down to lows around 350. But as I said before, I wouldn't be using this 13 EMA until an actual breakout was in play. And so actually we see here, once this resistance level and this triangle formation was broken, now we can go ahead and start using the 13 EMA. So first off, if you were going to buy this stock, you'd want to buy this stock as it broke out above this resistance level around here. So your second area of buying, like I said, where the only place I like to buy on the 13 EMA and where most people like to buy is on the first dip to the 13 EMA, as we see here. It didn't get all the way down to the 13 EMA, but price action dipped below. No indicator is perfect, so it's either going to be at, around, or below the 13 EMA. And that's exactly what happened here. It dipped, and then as soon as it dipped near the 13 EMA, there was a strong reaction where it broke out to new highs again. Then finally, it had a second retest of the 13 EMA. So the second retest is typically an area where you want to be a little bit more cautious. It's not typically an area where I would want to add to my position. This is the time to buy this stock right here, not to buy it up here. Even though it rose much higher, your risk reward level is much lower if you're buying a stock after it's way up above the breakout point. But as you can see here, the stock continued to ride the 13 EMA after this bounce. It had this awesome bounce off the 13 EMA on the second retest, and then went all the way up above 850, and then finally got the breakdown of the 13 EMA right here. As I said, when the stock breaks down the 13 EMA, it's typically an indication of either a slowdown in the trend or a reversal. And so after this broke the 13 EMA here, the stock was just kind of a choppy back and forth before finally really reversing down here and dropping back down to about 350, where it was up at 850 before. So this is a perfect example of the 13 EMA and using it as a short-term trend indicator. Now let's look at another one here. This is Google. Looking at this stock right now, throughout here for these months here, it was just kind of chopping back and forth through the 13 EMA. There's no real trend indication there. But once it broke out above this resistance level, now the 13 EMA is in play, and it's something that you can use. As you can see here, it broke out of this resistance level, had that first retest around here, and then kind of just rode along it right about here, and every time it got near the 13 EMA, it bounced. And then finally up here, it got that breakdown, the actual strong candle moving below the 13 EMA, which led from it going up about $630 down to about $583 in a short-term amount of time. Here's another one. Looking through here, this stock is kind of chopping through the 13 EMA. It's not an indicator we want to be using. But once it actually breaks out above a chart pattern in resistance, now the 13 EMA is in play. So it actually rallied here, and then 2 days later, it went all the way back down and retested the 13 EMA pretty much exactly, and then had a strong bounce here. Went from about 275 all the way up to 425 in just a couple matter of days. So we'll be getting into soon about taking your profits, but this actually, once it broke down the 13 EMA and had a strong close below it, this trend completely reversed and actually went back down to 95 cents 6 months later. So this is another good example of the 13 EMA. The first retest right there is a good spot to add to your position or buy a new position if you didn't buy initially on the first breakout, and then you usually get a strong breakout reaction off that first 13 EMA bounce. Same thing here. This stock was typically trading along the 13 EMA, trending along it for this whole uptrend here. This is a false breakdown of the 13 EMA, and that's just a great example of that no indicator is perfect. As you can see here, it's kind of trading in a tight range above or below the 13 EMA. It's not actually breaking down below it. Then finally had some strong closes below here, which could indicate a reversal in trend. But shortly after, it bounced back up and then continued riding the 13 EMA trend here. But these, this is just a trend here. It's not actually a real strong breakout that I would be looking for. Once it broke out above this $8 resistance level, now this is when I would like to buy into a stock on this breakout and then continue to use the 13 EMA as a trend indicator. And as you can see here, once it broke out above the $8 resistance, that was the time to buy. And then it rallied up and then came back down. And then that first test of the 13 EMA was a solid chance to buy into the stock on the first retest. And then it had that strong reaction here and rose all the way up to about $11 per share before finally breaking down right here and moved back actually all the way down to $8. And then this was just kind of choppy here and there. Afterwards, it eventually went all the way back up to $12, but we're only trying to play this short-term reaction off the breakout point. So you could have bought this stock at $8 per share, maybe even bought in on the dip right here at the 13 EMA and tried to sell up in this range here before or after it broke down the 13 EMA. Here's an example of a breakout pattern here as this broke out above the 475 level. It had this peak here and then peaked out and then finally broke out. Shortly after it broke out, it wasn't able to hold the 13 EMA trend. So as soon as that has that strong close below the 13 EMA, that's a good indication that this may be a false breakout and the trend is reversed. And that's exactly what happened here. We got that breakout. This looks like a solid buy. So you buy into the stock, then all of a sudden the stock starts falling and breaks down the 13 EMA. And that's exactly what happened here. The trend was completely reversed. It went from about 475 all the way down to $3 per share in a short amount of time. Then looking back here again, it peaked out here and then peaked out again. So now you have that resistance level. Once it broke out, it continued to ride the 13 EMA trend all the way from about 375 up to 575. But it was kind of a sketchy trend here. As I was saying, no indicator is perfect. This was trading in a tight range at or around the 13 EMA, so it never got really a strong close below it. But it was actually breaking down below it in the middle of the day as the stock was trading. So this would have been a tough stock to hold, as it was kind of kept continually breaking down the 13 EMA if you were following the 13 EMA as a potential stop level. Here's another example of a breakout that was failed, and so this was a great looking chart pattern. Solid resistance form at $4. It broke out on increased volume, so that's a buy indication there. So now the 13 EMA is a new trend indicator in play. But as soon as it broke out, shortly after, it broke right down back below the $4 support area, which is the first indicator of you should get out of the stock. Then it broke down the 13 EMA and completely reversed the trend from the breakout at 4, and now it went all the way back down to 53 cents. And as you can see, it rode the 13 EMA trend down here on the bear side as well, slightly breaking out above it on several occasions, but overall the 13 EMA trend held strong for the bears after this broke down. Here's another great example of the 13 EMA of, there's no indication of how high a stock can go. As long as the stock rides the 13 EMA and stays above it, the trend is bullish. So this was an awesome looking chart pattern here as this broke above this resistance level, and then it actually never even really gave you a chance to buy on a pullback near the 13 EMA. But this has continued riding from all the way from about the mid sixes up to about $20 per share before actually breaking down the 13 EMA in the $15 to $18, $17 range here. So if you buy into a great looking foos pattern, if you can have the patience to hold through all these days of the stock continuing up, as long as the stock stays above the 13 EMA, the trend is considered bullish. So there's really no telling to how high the stock is going to go. As long as it stays above the 13 EMA, the trend's bullish. So that's exactly what this did here. It broke out from about mid sixes and this ran all the way up to $20. So this could have been a huge trade if you followed the 13 EMA on this stock. Here's another trade here, WYY. As this broke out here, it broke out above this resistance level, had that breakout, then it came back down, slightly dropped below the 13 EMA, but this was the first retest of the 13 EMA, so this is a strong area where you could potentially buy into this stock, and as that's exactly what it did. It had this strong reaction off this 13 EMA, and then bounced all the way back up to about above 120 from about 85 cents. So that's a huge move there that you could have capitalized on if you bought into this stock on the dip to the first 13 EMA. Oh, whoops. Bought into the stock on the first EMA test. And then it finally broke down the 13 EMA up in the 110 or about 105 level here, and then the trend reversed. And then the same thing happened here again. We got this resistance level formed, followed by a breakout, and then this just rode the 13 EMA perfectly all the way up till it finally broke down about the 135 level. So here was the buy indicator on this breakout above the high 80s level, 80 cents area range. Then it got this solid rally, and then there's the first retest of the 13 EMA. I probably wouldn't have considered buying this, as it actually rose significantly off this breakout before first retesting the 13 EMA. But if you did buy it off this first 13 EMA bounce, it went from that's about 105 all the way up to the 150 areas. But the 13 EMA held strong 1, 2, 3, about 4 times before it actually officially broke down, and the stock started to slide off the bullish trend, and then in favor of the bears. So that's just several examples of using the 13 EMA as a short-term trend indicator, as well as an area of where you might want to get out of a stock once it breaks down, as well as an area of where you might want to buy a stock on a dip after it first retests the 13 EMA level following a breakout. But again, remember, it's important to note that you can't just use the 13 EMA at any given time. Just a perfect example here. Look at this. The 13 EMA is just chopping through the middle of price action. Here it is, chopping through the middle of price action. You only use the 13 EMA following a breakout of resistance of a certain chart pattern, and that's exactly what we're going to go over next, is how to identify the FUS4 chart patterns. Okay, so I've been talking about breakouts, and now we're actually going to go over what breakouts are, how to identify, and how to buy them. So when you start talking stocks with someone or are chiming in on website stock market chat rooms, you'll hear a lot of financial and trading lingo. But there's one word that stands out ahead of the rest when it comes to trading my strategy, and that's the word breakout. A breakout basically means that a stock just broke out to new highs above a past high price or resistance level. When a stock breaks out to new highs above resistance levels, this can be just the beginning of some huge momentum causing some very large gains in price action, which is why I like to play into the momentum on breakouts. Take note that certain criteria must be met for me to be interested, as there are many different kinds of breakouts in the stock market. Also take note that just because you find a breakout that meets the right criteria does not mean that it's going to work out in your favor, as I'll repeat once again that nothing in the stock market works perfectly every time. The goal is to be able to find and trade the right breakouts with a disciplined trading strategy so that you cut your losses on the ones that don't work out and you maximize your gains on the ones that do. Trading breakouts is the foundation of my strategy, and I have been mastering the breakout pattern for the past 6 years. Typically in small cap stocks under $10 or so, solid breakout patterns very commonly post gains of 20% to 100% return in a matter of days to weeks when they play out in our favor. A major factor that influences the reliability of a breakout working in your favor is how strong or weak is the market. Buying into breakouts while the market is hot or on up days gives you a much higher probability of success than if you are buying into breakouts when the market is weak or on a down day. So while this strategy can work in all types of markets, your rate of success will be much higher on days when the market is strong, obviously, as we are buying into momentum and we want the stocks to go up. One way to try to gauge how aggressive you should be in the stock market is going long with breakout plays, is charting the Dow Jones or S&P 500 or NASDAQ with the 13 EMA trend indicator that we were just speaking about. I personally use the Dow Jones Industrial Index to gauge the market. When the market is riding above the 13 EMA, this is the time you can be most aggressive and have the highest success rate in the stock market trading this strategy. When the market is trading below the 13 EMA, it's an indication of short-term weakness, which will definitely have an impact on stocks continuing higher following a breakout as the market is trending lower. If the stock market is very choppy back and forth across the 13 EMA and sideways action, then this is a neutral zone, which can be very confusing as stocks can't decide what direction they want to go. It makes it difficult to trade as the markets are swinging wildly back and forth, battling for directional movement. So here's an example of the Dow Jones basically over the past 2 years since 2009. So the blue line again is the 13 EMA, and this is the Dow Jones Industrial Index. You can look this up at stockcharts.com under the ticker money sign INDU. So basically, as you can see here from the beginning of 2009, we started off in a very bearish trend still, and this was actually the market bottom of the recession down here at 6,500. So during this time, this was a difficult time to be trading breakout stocks, as this market was just in complete free fall, down from about 9,000 down all the way to 6,500. And then in about March of 2009, we began riding the 13 EMA again, and this was a great opportunity to be making money. And then it came back down here. It had an official breakdown about below the 13 EMA. And so these months right here were, a little bit slower, and it was a time that you might want to be a little bit more cautious with your trading. And then again here we started trending along the 13 EMA again. So these were great months to be trading breakouts. Basically, it works when it's riding the 13 EMA. It's because if you're buying into a breakout, this gives your stock to continue to have momentum going forward. Rather, if you buy into a breakout stock, and then all of a sudden the market that overall in general is free falling, this is going to have a huge impact on the ability of your stock that you're individually long in to maintain its actual trend. So you basically just want to see the 13 EMA being ridden on the Dow, so that you have some confidence in your stocks that you're currently holding to be able to have some strong momentum going after their breakouts. So you can see here just different times of the year when we were able to make a lot of money, and then other times of the year where price action was very choppy, going back along the 13 EMA. And this was the times when you want to be more conservative with your money, be more conservative with your stops, take your profits earlier, and maybe trade in less sizable positions. So for most of the year, there is definitely plenty of opportunities over the past 2 years to make the most out of this strategy. Now looking back here, I started trading in 2005, so this is basically the history of the stock market since I've been trading, and we actually just went through, quite possibly the biggest or second biggest recession ever in the history of the stock market, so that was definitely a difficult time. So throughout 2005, obviously the market was generally up, and the 13 EMA, you can't really see it with this chart because the time frame is so small here, or the chart's so small and compared to the size of the time frame. But for the majority up until about 2007, this was an awesome time to be trading this strategy. And actually, even though 2007 to about September 2008, the market was generally trading down, we actually had some of our biggest opportunities in this section, as there definitely was times when the market was going up. So we actually had a great 2007 and a great 2008 up until about September. Throughout 2006 to about April 2008, this was when I was running my website for free. So this was all me sharing my stock perks for free. Excuse me. It wasn't until April of 2008 I moved to San Diego, and then I started what's known as Black Service, my real-time stock picking service. So we had this awesome. I was sitting here having an awesome time, and then all of a sudden, when I finally decided to start a company, this is right at the beginning of the recession, so my timing was a little off, but we're still here, so we have survived throughout this whole fiasco. But basically in 2008 September, things were going pretty good. Even though the market was falling here, this was rough, but things were still semi-okay. It wasn't until September of 2008 when shit really started to hit the fan, and it just became almost an untradeable market. This was days when the Dow would swing up 1,000 points one day, and it would fall 1,000 points the next day. It was complete insanity. It was ludicrous. There was no way of consistently being able to predict what the hell was going to happen with this market. So, I hung out for a couple months, trying to figure out how to trade this market, and it was very difficult to have any kind of success during this period. So I actually took a couple of months off. I was actually downtown bartending in San Diego. Just it wasn't worth trying to risk your market in this game. This was when major banks that have been around for years, Bear Stearns, major hedge funds, professional traders that have been in the business for 30 years, they were all busting out, losing all their money, and all these companies were going out of business. This was financial reform, and everything was just coming to an end. It wasn't until April, or I think it was February, March of 2009 when I finally decided that it looked like the bottom was in the market, and we dove in head first. Finally, in March of 2009, and that's what I just went over here. In these two slides, this was when it bottomed in March. We actually dove in late March, and then we just absolutely killed it and actually had our best year in 2009 with the Black Service stock picks. So here, this was just there was nothing you could do. We went through a recession. The market, it was complete chaos, and that's just something that happens in your lifetime. So hopefully we never have to live through something like this again, and hopefully moving forward we can have much more years like the rest of 2009 through 2010, as well as has good years like 2005 through most of 2008. The breakouts that I trade must meet certain criteria for me to be interested in potentially trading the breakout setup. I call this breakout setup the three-phase breakout formation, which consists of three different phases that form in sequence and are typically in the shape of some sort of triangular pattern. In phase 1, there's a large move in price action that is also accompanied by a significant increase in volume that is above the stock's average volume levels. This is usually sparked by some kind of news release, or maybe the stock has been beaten down and a lot of people find the stock at a bargain and a massive buyers come in. This is just phase 1 of the formation. Buying in on the first phase is a very unreliable strategy, as it is highly unpredictable what will happen after the stock's first initial move. In phase 2, the momentum and volume from phase 1 rally lose steam and the stock consolidates for any given time period. During this consolidation, the chart pattern is formed by forming support and resistance areas based on the relative highs and lows of price action. The most important sign of a potential three-phase breakout formation here is that the stock makes higher lows each time that it dips and creates an ascending support line, and the angle of the triangle begins to form. While the highs of the consolidation form the neckline resistance of the triangle breakout formation and give you a buy trigger based on price moving above the neckline resistance point. Buying small portions in phase 2 before the breakout actually occurs can result in higher profits, yet I often try to avoid doing this, as it is fairly hard to monitor the trade setups prior to the stock making it to the actual phase 3 breakout. In addition, a great multitude of stocks never make it to phase 3, so you may lose a lot of money trying to predict a three-phase breakout formation that never happens because it never makes it out of phase 2. Phase 3 is the last and absolutely most important step of this pattern. As I just said, many stocks never make it to phase 3, but will form phases 1 and 2. When a stock hits Thray's feed, this is confirmation that this trading setup is in play, and a huge move in price action may just be around the corner. This is why I typically only buy into stocks once they have hit the third and final phase, because the probability of the trade working out in your favor is much higher than trying to anticipate a phase 3 coming into play. Usually on the three-phase breakout formation, on the phase 3, a significant increase of buying volume comes in and gives us confirmation of the breakout. On the day of the breakout, we want to see a strong candle with the price closing near the highs of the day. In addition, we want volume on that day to be significantly higher than the average trading volume of the stock. From here, we should expect that a multi-day run will occur or the stock will form a new trend along the 13 EMA for any given amount of time. So here is a perfect example of a three-phase breakout formation. First, we have this large spike in price action plus increased volume as this phase 1 plays out. So first phase is you get the volume increase plus the price increase. In phase 2, we get the consolidation formed, where the actual chart pattern is formed. As I said, you get higher lows, and then you can connect the ascending trend line here, so now you have the ascending trend line of the triangle, whereas the highs never break out above the highs of phase 1, and this creates the neckline resistance, where you actually have a buy trigger now of where you want to buy if and when price breaks out above this level. Then in phase three finally comes along if and when it breaks out above that buy trigger, above the past highs of phase one and phase two. This is a signal that it's potentially time to buy into this breakout, and you want to see volume increase. As you can see here, on this day of the breakout, we had a strong candle closing near the high of the day with a spike in volume. That's an indication of a potential new trend, or at least multi-day run coming up ahead. And as you can see here with this stock CPQQ, you could buy into this stock here on this breakout, and this went from about $2 per share, and it rose about 100% in a very short amount of time, up to even up to 450. If you rode the 13 EMA on this stock, you maybe would have gotten stopped out here. As you can see, no indicator is perfect. Once again, this barely broke down below the 13 EMA and then rallied into the close and actually bounced off the 13 EMA and made another solid rally after that, but then finally broke down the 13 EMA strong up here before it reversed the trend. But this is a perfect example of a three-phase breakout formation where you get that first phase one with volume plus price. Phase two, the actual chart formation, is formed where you get the resistance areas for your buy trigger at the neckline, as well as the ascending trend line from the higher lows. And then the phase three, where you get the actual breakout on volume, and then you can ride the 13 EMA trend, and hopefully, in turn, use some trading rules and turn out some profits on this trade. So when it comes to trading my strategy, you can basically call me a triangle trader. In fact, just about every variation of any breakout chart pattern takes form of a triangle leading into the breakout point. The three-phase breakout pattern is at its best form in pure ascending triangle formation, though will also take form in other variations of symmetrical triangles or wedge patterns. Yet all are basically some form of triangle. I have four different variations of this exact same three-phase breakout pattern that I call the Foos 4. What makes them different is the criteria and trends leading into the formation of the three-phase breakout pattern, which can indicate several different things, such as profit potential and stock sentiment. These are called the Foos patterns, of which I have coined the terms force, survival, revival, and gold. The force pattern is my go-to chart when it comes to my strategy. It's the most consistently profitable three-phase breakout chart of all the Foos patterns that we have in stock. Not only is this a very consistent pattern, it also has some of the largest percentage returns of all the Foos 4 patterns. The force pattern is reliable because the trend leading into the three-phase breakout formation is bullish or neutral. If the lead-in trend is bullish, the sentiment towards this stock is already positive, and the crowd following this stock is in the mood to buy. So when the breakout occurs, this further reinforces the bullish sentiment to the current holders of the stock, as well as brings in a massive new buyers to the stock as it's breaking out, which can send the stock significantly higher. A neutral trend can also have the same soaring effect, because if a stock is trading in a neutral trend for a while, then there are a lot of people who are sitting on the sidelines waiting for the stock to make a move before they hop in. Once a three-phase triangle breakout forms and occurs, this signifies the possible end of the flat or neutral trend and the beginning of a possible new bullish trend, which brings in a lot of momentum, and traders from the sidelines hop in to catch the stock on the move, as this is a new possible bullish trend where you could see significant profits. So let's take a look at some examples of force patterns. Here we have GGAL. As you can see here, the lead-in trend is bullish or almost semi-neutral, as this is kind of a flat trading for a while here. And then we got this first spike in price action and a significant little bit of volume here, followed by the consolidation in phase two, where the stock forms its ascending trend line, as well as forms its neckline resistance, which gives you an indication of where to buy if and when the neckline breaks out. As you can see here, once it broke out, it got that huge spike in volume that we look for on the phase three confirmation. From there, this is about $6.50 per share. It rose from $6.50 all the way up to about $9 per share. And even from this first move, this was the beginning of another three-phase breakout formation, which formed here with this first spike in price plus volume. Then we have phase two forming this consolidation with the ascending trend, followed by the neckline resistance formed, followed by another breakout from $9 all the way up to $10 per share, which actually led to a third and smaller force pattern here, which broke out again with another significant increase in volume. From there, it went from about $10.25 all the way up to $16 per share. So this is an excellent example of force patterns that occurred in sequence. As this, it first started out with this large ascending triangle right here, this force pattern, followed by another force pattern, and then followed by another third force pattern. So there's 3 trigger buys here that you could have bought here, rode this first spike up, bought here, rode this spike, bought again here, and rode this spike again once again. So this is a great example of 3 force patterns that were in play in sequence. Here's another force pattern is here as well. You see here the lead-in trend is semi-neutral. You got this first rise in price action. Got this first significant spike in volume here, which led to the rise in price. Phase 2 consolidation. Then we got another big spike here in volume where price came back up and tested this neckline. So now we have a neckline resistance formed and actually formed a smaller mini triangle here, which broke out around $2 per share on significant volume in this. So this is the phase 3 breakout here once this breaks out this neckline. As soon as that occurs, you want to buy into the stock, and as you can see here, it went from about $2 per share all the way up to $3.50 in a very short amount of time. Here's another one, REE. This was a fairly flat to neutral trend here, and then we first got this this long mediocre trend here that was neutral, but it formed this neckline resistance here at $4 per share. So got this first rise in price, retested it here, and then it actually came back down. So this is kind of a not really a triangle formation, but as I said before, almost all breakouts leading into the breakout, there's a triangle formation. So as you can see, the ascending trend was formed here, and as soon as this $4 area was broken, this was a huge buy signal here with volume increasing, and this led to the stock going from $4 all the way up to $14 per share in just a few months. Here's another force pattern that happened in consecutive sequences. So you got that first rise in trend. The lead in trend here is neutral. It got this first rise in price action. You don't see too much significant in volume increase, but their trend was formed here, followed by the consolidation where you can draw this ascending trend line. As soon as this spike right here in price got an increase in volume, which retested the neckline resistance here, and now we have that buy trigger as soon as this breaks. And as soon as that broke right here around $5 per share, we got a significant increase in volume, which led to a huge gain from about $5 per share up to the mid 7s area. From here, the trend that's the first, so now we have a bullish lead-in trend to the second consecutive force pattern. We got that first rise in price in phase 1 plus increase in volume. Now in phase 2, we got the ascending trend and the neckline formed, and as soon as that broke above resistance at $8 per share, we got that huge spike in volume again, which led to this just a huge rally here from $8 all the way up to about $15 plus in a very short amount of time. Here is another one, VHC. You can see here the lead-in trend is somewhat bullish, but it's more like a very neutral trend. But we first got that first phase 1 with the rise in price plus volume. Phase 2 is the consolidation phase where you can connect the ascending trend as well as the neckline resistance. As soon as that breaks out above this neckline, you see the increase in volume plus just a massive run from about $7 per share up to $20 per share in just about a month. Another one here, you don't always see those gigantic moves of the stock tripling, but here's one with MSPD. You can see here this has had a strong lead-in trend that was very bullish, and this is a very much shorter term force pattern formed here, which broke out above the resistance right around $5 on this neckline, which led to a breakout on increased volume, and then you saw shortly thereafter more increased volume, which led for this going from about $5 per share all the way up to about $9 per share here, which actually led to another force pattern breakout. This actually was a false breakout on this force pattern. It ended up dropping shortly after, though. Here's Joe's Jeans. This is you can see here this first spike in price plus volume. As you can see here, this is an example of this is a symmetrical triangle breakout So we got that first spike plus price in phase one, followed by the symmetrical triangle formation, which actually broke out here. You didn't see too much of a significant increase in volume here when this broke out, but it actually broke out again here above this 150 level on this candle on a little bit increase in volume, and then didn't really do much, but it still trended up. From there, this is another mini force pattern that got that first spike in price with the lead-in trend was bullish, so we got the spike in price plus volume on phase one, and then a short-term phase two consolidation, then followed by a breakout at about let's see 287 or so there, which led to just a short 3-day spike where you could have made a decent gain here just buying into this short-term pattern. Then here we got RNN. As you can see here, the lead-in trend is fairly neutral here. And then we got this huge spike in volume plus price here, which created the phase one run here, followed by the phase two consolidation, where we were able to form the ascending trend line. Plus this spiked up here and failed to break out, and then spiked up again, and that formed our nice little neckline resistance at 150, giving us a good indication of where to buy if and when this stock breaks out above this level. So then in phase three, we had this huge spike in price action where it broke 150, and that's our trigger to buy into this stock. And from there, it just blew up from about 150 up to 365 in just a very short amount of time. Same thing here is another pharmaceutical company, RXII. Lead-in trend is fairly neutral. And then we got this spike up here with a nice increase in volume plus price going. This almost doubled just from going about right here from 3 up to 6 in a short amount of time. Then from here, we were able to form this ascending trend line, connecting it here, and also this this is a little bit more of a wedge pattern here. So then we were able to draw these relative highs together, forming this neckline resistance, which gave us the buy trigger as soon as it broke out above this neckline resistance line. Then on the phase three breakout, we got the confirmed volume here, plus the price, a nice spike in price with a strong candle closing near its high of the day. From there, it went from about 570 or so all the way up to $9 per share in about 2 weeks. All right, so up next, we're talking about the Foos revival pattern. So the revival pattern is also a very potent pattern to play as a variation of the three-phase breakout. The lead-in trend of this pattern is bearish, so the current sentiment of the stock is negative as the revival pattern is coming into form. But when the breakout actually occurs, this could possibly be a huge sign that the once bearish stock is on the verge of a bullish trend reversal and could be revived. This pattern attracts and scares people away at the same time, which is why it works. For those who are bargain shopping on a stock with this pattern, this is an indication that the bottom may be in play, and this current three-phase breakout pattern could spark a huge rebound for this stock. Also being that the trend in sentiment on the stock is currently bearish, a three-phase breakout pattern can cause a huge short squeeze to occur, driving price action higher and higher as people who were short the stock are influenced to cover their positions, which increases the buying pressure. The result of both the attraction of new buyers and scared shorts working together can be a highly potent pattern to trade. Although it is important to take note that picking the bottom of a bearish trend is a very difficult thing to do. The revival pattern is in fact the most inconsistent Foos pattern to trade, as many times breakouts in revival form are quickly demolished by those who are too scared to continue holding and take their profits as price breaks to new recent highs. As well, if the sentiment in the overall stock market is still very bearish, then this spike in price may just attract more people to short this stock at a higher price rather than buy into it. Now, revival patterns can definitely post some huge returns, but again, take note that this is the most inconsistently working Foos pattern and oftentimes can be false breakouts. Yet the revival pattern is also one of the most common patterns to come across as well. So in trading revival patterns, it's wiser to keep your stops tighter and possibly trade with lighter positions to cut down on risk. But also, the revival pattern it's so common out there, and when these do work out, you actually see some huge gains on these trading positions. So let's take a look at a couple examples here of a Foos revival. So you can see here the lead-in trend on this stock short term is very bearish. It's dropping from about 175 all the way down to below a dollar. But once this forms this three-phase triangle breakout pattern that you can draw here with this neckline as well as this ascending trend, and it's broke out above $1 on this huge spike in volume, that's an indication that this may have a bottom here in which you could buy into for a short squeeze. And that's exactly what happened here. As soon as this broke above this neckline resistance on this huge amount of volume of above a dollar, this quickly rose from about $1 up to about 155, which is a 55% return in just a matter of a few weeks, about a week and a half or so. Same thing here with ASTI. You can see the lead-in trend here is very bearish as the stock had just dropped from about $8.50 all the way down to $2 per share. And then we got this spike in price action here where you get the spike in price with the phase one on increased volume. Plus now we have the consolidation where we were able to draw the neckline resistance as well as the ascending trend. Then as soon as it broke out above here, this is the buy signal. As you can see here, it broke out and then had a significant sell-off which retested this breakout support in the 13 EMA and quickly bounced from here from about $3.50 all the way up to $6 per share in about 2 days. You can see this pattern here is very significant. But also you can see here, this was another very smaller revival pattern that to point out here where this had this descending trend here and then this neckline form that broke out to a quick gain. But also this quickly shortly after there significantly dropped. Same thing here as it looks like it could have bottomed, and then this breakout above here looks like it may have been a solid revival pattern to play, yet most people just sold right into this and it continued falling. Same thing here. You know, the stock sentiment is actually bearish. You know, this is a very bearish trend, but what happens when these revival patterns are formed, this attracts a lot of people to buy, as well as people who are short get scared out of their positions and end up covering, which causes this a massive buying pressure, which can spike the stock. But eventually, it usually continues to fall again because the stock's down here for a reason. You know, it's not a very good company. Here's another example. This is HDY. Here's a good example of a revival pattern that didn't work out too well, but you know it could have been profitable. Here's the lead-in trend here. It's bearish. Then this spikes in price action formed this neckline resistance, and we got this ascending trend right here. As soon as this broke out, that formed a buy signal at about $1 per share. I mean, it rose up to $1.40, so that's a 40% gain right there if you were able to trade this successfully. But then it quickly dropped all the way back down shortly thereafter. And then again here we have this another lead in here with another. This is actually a much better looking revival pattern with this nice triangle formation with this consolidation. Here we got the phase 2, and then when this broke out on phase 3 on the increase in volume, this went from 120 all the way up to 360 per share. So that was a 200% gain in a very short amount of time. This was actually an example of a force pattern before that we were looking at. When it broke out above $2 per share, that was a larger ascending force pattern that was a buy trigger on the move above 2. So we got this first buy trigger down here from the revival pattern, and then that was followed by another force buy pattern at $2 per share, which led to another huge move in the stock. Same thing here. We got the lead-in trend is bearish here, followed by once this ascending three-phase breakout pattern is formed, we got the neckline resistance right here about 90 cents. Then we can draw this ascending trend line, and then on this breakout we got this nice big spike in volume leading in. And then on this break, that's their buy trigger right here at 90 cents. As you can see, it rose up here and then bounced down here at the 13 EMA. Whoops. Bounced to the 13 EMA that we were talking about, where it's potential buy areas on the first retest of the 13 EMA. Then from here, it rose all the way up to $2 per share, above $2, about 201 or 210. So this is another extremely good example of a revival pattern, and just to show how big of these reactions can cause once the momentum starts to get going on a solid revival play. Here's another example, red F. You can see here the lead-in trend is bearish. And we got this another short-term lead-in trend here that was formed, followed by this solid three-phase breakout formation here with the neckline resistance formed where we have a buy trigger. Then we have the ascending trend line we can connect. So we had some nice volume coming in prior to this breakout. Then when it broke above this 225 neckline, we got this nice spike in volume which led to the breakout, and this just blew up so huge from 225 all the way up to $6.25 per share in a very short amount of time. Same thing here with Zinc Horsehead Holding Corp. The lead-in trend is bearish. Then we get this three-phase triangle formation formed. We got the phase 2 consolidation. Again, we have the neckline resistance formed right here, about $9 per share with the ascending trend. As soon as this breaks with this nice little spike in volume plus price, a decent looking candle, went from about $9 per share all the way up to about $13 per share in about a month and a half. So it's another great looking revival pattern. As soon as these breakouts occur right here, this is our buy trigger in which we can hold the stock for a couple weeks to a couple months, depending on how long you want to hold the stock. Also, just looking at the 13 EMA is a good indication of how long you want to hold it, depending on if it breaks down or not. So looking here, it broke down. You might have got stopped out on these days as it broke down if you got scared out of your position. Same thing here, CNXT, lead-in trend, short-term trend here is bearish. Now we have this kind of wedge pattern formed here with this three-phase breakout consolidation, and then as soon as this broke above the resistance level, we got a decent little spike in volume here, but volume didn't really pick up about until here. But if you buy here, you could ride the 13 EMA all the way up here, and then this really broke out above here, and then came back down, retested the 13 EMA again before finally breaking down up here and then reversing the trend somewhat. But as you can see here, the buy-in trigger was all the way down here at 250 with this solid looking revival pattern. Here's another short-term revival pattern in play. We got the lead-in trend here. This formed this nice little three-phase breakout formation here. We got this neckline resistance formed plus this ascending trend line. As soon as this broke out, that gave you a quick 2-day rally. If you would have bought in here, you could have sold it up here on these on this quick spike for a nice little profits. And then as soon as that happened again, there was some decent resistance about in the low $2 area, and that led to another decline in price, but it actually gave you another opportunity to buy in on another revival pattern with this short-term drawback. And then we have this neckline resistance form about 150, and then it broke out of 150 on increased volume and led to another huge move from 150 up to $2 plus. And then here we got this survival pattern, which is the pattern that we're going to talk about after this. So this is another great example of a survival pattern here. It's going to be the next topic we talk about. Here's another. This is CHTP. This actually is a biotech stock. So we got this huge gap down in price action. We'll talk about biotech stocks a little bit later in this DVD and just kind of the risks involved. You can see how crappy it would be to be holding the stock at $7 per share. And all of a sudden, next day you wake up and it's opening up about $2 per share. But the lead-in trend here, we got this gap down, so it's bearish on this stock, but it formed this great-looking three-phase breakout formation, and as soon as that broke above this neckline resistance at $3 per share, you got a quick little rally up to $4 per share here that you could have capitalized on this trade. Same thing here. This is just another example of another revival pattern, just getting in and out. This is a 3-day rally based off this lead-in trend is bearish. The stock tried to rally here, and then this just got hammered afterwards. But after that, we got this spike in price from here to here, and this nice huge spike in volume. Then we have the phase 2 consolidation, and then phase 3 when this broke out. That's your buy trigger. In the 260s, and from about 260 it rose up to 320, up back to these past spikes resistance levels up here where you could have capitalized on buying on this breakout, ensuring and selling into the resistance level. There's another short-term example of a revival pattern. Is this lead-in trend here is bearish, and then we have this three-phase breakout formation here. We got this nice spike right here and price plus this volume, so this is kind of an indication that something might be up with this stock here. And then it came back down, so then it had these two spikes up here where you can draw your neckline. As soon as it broke above that spike or that resistance level, we had this nice spike in volume, which led to this breakout, which just moved up 2 days here and then kind of consolidated for a little bit, and then retested the first test of the 13 EMA again, which is where I was talking about is your a great place to rebuy into a stock after it breaks out. And as soon as it retested that area, it just blew up again up to this past spike resistance here, about 350. From there, that's actually formed another force pattern here with this neckline resistance drawn here about 350. You can connect this ascending trend from here to here, and that broke out here on this huge amount of volume above 350, which led it from a move of about 350 out to $5 in a very short amount of time. Here's another revival pattern here. This lead-in trend is very bearish. This had this first spike up in price. This could have been a revival pattern here, but as you can see, this failed and then broke back down, and then it formed this another wedge right here, which formed another three-phase breakout formation. And as soon as it broke out right here, we got this spike in volume, which led from a huge move from about 240 or so up to 375 in just about 3 or 4 days. Okay, so the next chart pattern we're going to talk about is the Foos survival pattern. So these patterns are typically formed following large rallies in a stock's price, and can also often occur following large moves that were made from the other Foos 4 patterns, like the Force, Revival, or Gold patterns. The survival pattern in a nutshell basically means that the stock has survived the inevitable profit-taking and retracement after a huge rally, and instead of losing all its steam, price soon finds support, the trend remains bullish overall, and a short-term three-phase triangle pattern is formed within the trend, yet below the recent highs of the stock's last move. Survival pattern and revival pattern can often look very similar, yet the survival pattern forms within a short or long-term bullish trend. It's essentially a mini revival pattern within a short-term bullish trending stock. But don't let this make you think this can only produce mini moves, as when these patterns play out, this is simply a continuation of a potentially large follow-through in the current short-term bullish trend. When you buy into a survival pattern, the first profit target is typically the peak resistance of the initial large move that the stock is surviving from. It is very common for price to halt near this resistance area and fall. Yet, if price breaks through the prior peak resistance, it can also result in some huge moves to new highs of the pattern. So as you can see here in this illustration, the leading trend is it's a bullish trend, and you see a large spike in price. From there, you see some profit taking, and instead of the stock just completely crashing, it soon finds support and forms a three-phase triangle formation in which you are able to buy into the breakout. And then from there, the first target is the actual past peak resistance level. But then if this if the breakout continues through this past peak, this can also signify another huge move as this breaks out to new highs above this resistance, and the stock continues. And also for survival patterns, you want to see it stay above where the actual first spike in price began. If it breaks down below that, that basically means the stock didn't survive this bullish move. So you want to see it stay above where the bullish trend initiated. So let's take a look at a couple examples here of a Foos survival pattern. So you can see here, here's also just another example of a failed revival pattern. I don't have the lines drawn here, but you can see here the lead-in trend here is bearish, and here's the neckline resistance you could have drawn here with the ascending trend line. We had all the volume indications were there, but it broke out above this resistance right around here, and then this soon failed. So that's a pretty good example of a failed revival pattern. But then moving forward, going on to the survival, you can see this huge spike in price action, this big, huge rally, but then there wasn't really much of a pattern there to trade. And then after that rally formed, there was some profit taking, and instead of it just completely crashing, well, it did crash, but it stayed above where this initiated in the first beginning of the trend. It actually bounced right here at the 13 EMA support. And after that, we got this short-term consolidation where this wedge pattern is formed, which is a three-phase triangle breakout. And as soon as that broke above this resistance here, right about $2 per share, that's your buy trigger right here to buy into it. And where your profit target is first going to be is at this past peak right here. And that's exactly what it did within 2 days, from about $2 up to about $2.50. It actually closed right at the past resistance. And then the following day, it spiked up above and then actually kind of came back down right after anyways. But that's a great example of a survival pattern. So you get that first spike in price, And then the retracement, instead of it falling all the way back down to where it started, it survived the initial profit taking, found support, as you can see here, it found support at the 13 EMA, formed this consolidation of the three-phase breakout pattern. As soon as that breaks out, that's your buy signal. Then the first profit target is the past peak resistance of the first initial move. Same thing here with WaveX. You see this huge move in price action here plus volume. Then the profit taking comes in. It actually finds support right down near the 13 EMA. Forms this great looking three-phase triangle breakout formation with its neckline resistance here at about 250. So as soon as that breaks out above this resistance at 250, that's your buy trigger. You got a little bit of a spike in volume, not a huge one on this breakout, but the overall pattern is there. So your first profit target is the peak resistance of the past initial move, which was $3 here. So this spiked up here, consolidated, and then broke out again right here. Kind of stalled out about $3, but as soon as it broke above this resistance, as I said, if it breaks above the past peak, there can be another huge significant move, and that's exactly what happened throughout the week here, from about $3 up to $4.75 in a matter of days. Here's another survival pattern here. Is this leading in? We got this big, huge spike in price action here from about 125 up to about 225, so about $1 per share gain here on a small stock like this. That's a pretty significant move. And then the inevitable profit taking found support right near the 13 EMA, followed by this consolidation here with this wedge pattern or three-phase triangle pattern. And then it broke out above this resistance here, which led to a spike in volume and a nice strong candle that closed near the high of the day, and that led to a move breaking. It actually broke above the past peak resistance, which is your first profit target, and then went slightly above it, where you could take more profits even at a higher price. Here's another great example of a survival pattern. The lead-in trend here, so the trend is very bullish on this stock as we go in here. You got that huge spike in price plus volume. Then the inevitable profit taking. This again found support at the 13 EMA, followed by this three-phase breakout formation here. And as soon as it broke above this resistance, right around 625, there was that increase in volume. It didn't get a very strong close here, but it still closed above this past peak level, which is still an indication to buy. And then just with the week later, it retested the past peak, which is your initial profit target, so you could buy here at about 625, and then $1 per share later up here at 725 is where your first initial profit target. From there, it just kind of hung out right above this about this resistance level. Here's another example of this one was actually a gap up, so it's just a single day large volume and price move just on one gap up, followed by some profit taking, but that eventually formed this ascending triangle formation that gave us the buy trigger price as soon as it broke above these resistance levels formed on this neckline resistance. So as soon as it broke above this resistance, you got that spike in volume, plus this big move in price action and a strong candle, which actually retested the past high on the first day. But as soon as it broke out above there, it went from $6.50 all the way up to $9 per share in just about 1, 2, 3, 4, 5, 6, 7, 8, 7 or 8, 9 days. So this is another great example of a survival pattern. Okay, so last and certainly not least is the Foos Gold pattern. So you're probably wondering why I would name this the Foos Gold pattern. Simply put, when you find this pattern and it plays out correctly, it's a huge gold mine. This is the pattern where I've had some of my largest gains, and it consistently gives 20 to 100% or even higher returns in just a matter of a few days to a few weeks. On the downside, this pattern can be extremely volatile and unstable, thus making it easy to get stopped out or even lose 10 to 20% fairly quickly if you allowed it. Yet with great risk also comes great potential reward. $1 per share is a huge psychological support and resistance area in small cap stocks. Probably even the most significant point of support and resistance out there in the whole entire market based on what kind of reactions you can get in stocks when breaking out from this golden area. The gold pattern occurs when you have a stock that has been trading under $1 per share for roughly 9 months to 2 years. During this time, the stock may peak up to the $1 area several times, further solidifying this resistance mark. Thus, the more failures to break out above 1, the more significant it will be if and when price does break above $1 per share. The long-term resistance doesn't always have to be right at $1 either. It may be slightly above or slightly below it. Although breaking above $1 per share is typically the breakout mark where you want to buy the stock as it's breaking out. Leading up to the final longer-term breakout or resistance, a shorter-term three-phase triangle breakout pattern is usually formed. So the short-term chart is extremely bullish in conjunction with the 9-month to 2-year resistance formed around the most significant support and resistance point in the stock market. The implications of a gold pattern are greatly significant. It is fairly common for a gold pattern to run from $1 per share to $2 per share in a few days to a few weeks, which is why this pattern is such a gold mine. The hard part is having the balls not to sell the stock before it gets to $2 per share. I've played a lot of gold patterns over the years, but always end up selling for about a 20 to 60% gain just to ensure my profits and avoid risking the collapse and losing all my profits. And then I see it run up near $2 per share when I could have made more money. It takes a lot of greed not to lock in your profit on high-flying stocks, and you'll soon learn that greed is not on your side. More often than not, that you'll kick yourself in your own ass because you did not lock on your profits when you should have. As with gold patterns, just as fast as the stock rose from $1 to $2, it can fall back down and commonly drop back down below $1. Though gold pattern is a hyped-up technical breakout pattern that explodes with no remorse. But once it runs out of fuel, it can drop back down just as fast as it rose, and sometimes never return to those highs again for a very long time, if ever. So don't get greedy with gold patterns. Start taking your profits on the way up as the pattern plays out. Gold patterns are my favorite of the four patterns because they are fairly reliable and they have the highest percentage returns of all 4 patterns in a very short amount of time. Yet the gold pattern is also the most rare pattern to find, so it's always really exciting when we come across one of these patterns to trade. But also remember, gold patterns can be very risky as well, and it's easy to lose a large amount of money if you don't set your stop losses, and also you can give up a lot of your profits if you don't take your profits while you have them and set your stops and stick to them. Okay, so now let's take a look at some actual real examples of the gold pattern. Here we have CHTL. This was a OTC BB stock. So you can see here we have this over a year, about a year and a half or so, of this stock trading below $1 per share, and it kept going up to $1 per share once, twice, then 3 times. So now we have this long-term resistance formed at $1 per share. So if and when this breaks out above 1, that's a significant sign that there could be a huge breakout, and this is like the the gold pattern does not get any better than this this pattern right here. This example with CHTL, it's almost the perfect pattern. As you can see here, we have these reaction points exactly off $1, and as I said, you can get that quick reaction from 1 up to $2 per share. But you can't be greedy with these stocks because just as fast as they rose to rose to $2 per share, they can also fall. So this went from about 1 to 2 in maybe about 2 weeks' time. And then shortly after that, it dropped all the way back down to 120. And I believe today the stock is down to about 30 cents. So these gold patterns, you really need to be diligent about locking in your profits while you have them. And also, as I said before, leading into the actual breakout right here, you'll see a short-term 3-phase breakout pattern, which will basically give you a sign of that you should buy on a short-term scale. And then if you look back about 9 months to 2 years, you'll see that this is actually a gold pattern as well as a 3-phase breakout formation. So as you can see here on this CHTL, seashells down by the seashore. It's kind of a tongue twister right there. But as you can see here, this we got this first spike in price action here, which made this nice neckline resistance to buy into. As well as this ascending trend line here with a solid volume. So as soon as this broke out of here, this also broke out above $1 per share. So on a short-term scale, this gave you a buy signal here as well. And then when you looked back on the longer-term chart, you see that this broke out above this huge significant resistance level at 1, signifying that this is a gold pattern on a longer term scale, and that your profit target could potentially be $2 per share in a short amount of time, and that's exactly what happened here. Within about 2 weeks, the stock went from $1 to $2 per share. Thus, you could have doubled your money in a very short amount of time with whatever you were investing in this. Same thing here. This is ESPH. You can see here, this is a great looking. This is it's a force pattern, but being that it's a $1 area chart pattern, this is a gold. And as I said before, it's not always at exactly at $1 per share. So the first breakout buy here was actually around 75 cents, but this was a very strong force pattern here. In addition, I call this a gold as well because it's eventually breaking out above 1 and actually went all the way up to about $2 per share. So this is the longer term chart with the first initial breakout. And as I was saying before, leading into the breakout, you're going to see a three-phase breakout formation as well on the shorter term scale. So looking here at the shorter term scale, we have this excellent looking force pattern, this three-phase breakout formation with the first rise in price action plus volume, the phase 2 consolidation followed by the breakout on huge volume. So the buy signal first right here was about 75 cents per share on this short-term scale, and also looking back, 75 cents per share was resistance back here. So this is a huge significant breakout here, signifying that you could see a huge move. And then also in the short-term scale, again, we got this a consecutive force pattern in sequence here, where it actually halted at $1 per share, that significant level. And as soon as it broke above 1, this is absolutely skyrocketed from 1 up to about $2 per share in a very short amount of time. Moving on to the next force pattern, you can see here with ISCO. You can see here looking back for about 2 years. This came back down here and was trading under $1 per share for a while, spiked up here and failed, and then spiked up here around $1, actually went up to 120 and failed, spiked up again here at $1 and failed, and then finally had this downtrend here, and then finally came back up towards $1 per share again, where it actually went from 1 exactly almost up to $2 per share again. So looking at the short-term chart here, we got this short-term three-phase consolidation breakout pattern. We got the first spike in volume plus price, where it was halting out about $1 per share. And then as soon as this broke out above this level, above 1 on this nice strong candle plus a spike in volume, this just extremely quickly blew up from 1 all the way up to about $2 per share. But in reality, it's very hard to have the the guts to be buying here and be able to hold it throughout this whole session. Because as you can see here, if you're thinking that you're holding up here and you're just going to keep going up, look what it did in the next week. It went all the way back down to $1 per share. So you must be very diligent about taking your profits on these gold patterns, because just as quickly as they come up, they will come back down. Here's another gold pattern. This is ISR. As you can see here, this is a lead-in trend. It was very bearish, and then it came down and actually finally broke down below 1. Then it spiked up near 1 again here, halted right at $1 per share, and then hadn't been doing much before. And then leading into this actual breakout above 1, there was this three-phase triangle breakout confirmation formation. Got that first huge spike on volume, followed by the phase 2 consolidation. This actually gapped up in after-hours trading, so it would have been hard to buy into this breakout. As soon as it broke here, you would have to get extended hours. But then it opened up slightly above 1, and then came back down in the morning. And retested the $1 area, and then soon after it retested 1, a mass of buyers came in, and this just absolutely had a huge spike in price again, closed at $1.40 per share, and then 1 day later it went actually up to above $2 per share. So just another example of a gold pattern on about a 2-year scale here. So we got the first test of 1, and then the short-term triangle pattern leading into the breakout above 1, and then a move to 2, followed by, obviously, you got to take your profits on these gold patterns because they usually go up, and as soon as they go up, they actually come back down to about the $1 level. Here's another one, JYHW. Looking here, this was actually at 60 cents per share but which led to a short-term consolidation breakout above 1, which led to a move above $2 per share. So you can see here, got this spike up to about 60, spike up to 60 again, and then spike up 60 again. So this is about a little over a year scale we're looking at here. And then if we look at the short-term chart, we got this excellent looking force pattern, three-phase triangle formation here, with this first move in price and volume on this spike here, then the phase 2 consolidation, followed by this breakout above the neckline resistance on this huge spike in volume that actually broke above 1 on this day. So that was a big signal that it's time to go long in this stock for a potential move up towards $2 per share. And that's exactly what happened over the next few weeks. This just quickly rose from $1 up to $2 per share. And just as quickly as it rose from 2, this just absolutely collapsed all the way back down to 80 cents within a week of it being up at $2 per share. So it's always important that you need to take your profits. You know, when I play gold patterns, the few that I do, the few that I'm able to play, because you know you really only come across these several times a year. But I usually end up selling, you know, in the 140s or 150s area, and sometimes even the 120s areas, just because, you know, it's scary to hold in onto a stock once you have this huge 40 to 50% profit. It's hard not to just take your profits and move on without risking losing any money. Here's another one with VSTNQ. As you can see here, about a year and a half or so, it had been trading below $1. First off, it had this resistance levels formed around 75, and then the 50-cent level, spiking up here, spiking up again here around 50 cents, and then leading into the actual breakout above 1, we had that strong force pattern there where the trend here was pretty much neutral. And then looking on a short-term scale, you get that huge spike in price plus volume. You could actually, this could be considered a survival pattern almost right here. So we got that first spike in price. Then the sell-off, and then this kind of formed a short-term three-phase triangle breakout formation with a neckline resistance around 80 cents, and then it broke out right here at 80, which eventually led to the breakout above 1, which is the actual buy signal of the force pattern, and that led to a move up to about $1.80 per share, almost to $2. And then as soon as it reached up to about $2 per share, this is absolutely collapsed down within 3 days, back down to $1 per share.